Hello and welcome to my top 3 in trading and how to trade successfully. So let me just get right away into point 1. Point 1 is obviously the most important is money management. So when you're trading, you will often find yourself, you're sure prices will go into a certain direction and you want to invest all your money or use all your money to buy a product or an asset. But it is best to see that you manage your money. That means, don't use all your money, or just see how much you can lose in a trade. This is important, and you should never. This is a rule of thumb: never risk more than 1% of your total capital. So this means, obviously, if you have a lot of capital, you can, of course, invest larger sums of money or use higher leverage than if you don't have that much capital available. But this is generally a very sensible and good rule of thumb, and prevents you from depleting your depot by just making one wrong decision and thinking the prices will rise or fall, but they do the other thing. So that's number 1, money management. Number 2 is manage your expectations or expectation management. When trading, you should always view what you can lose and not so much what you can win, because you never know what you can win. You never know how successful your trade is going to be. Of course, you can determine price targets, but prices can do unexpected movements all the time, or you can just make a wrong assumption. And this just leads to the point that maybe if you expect 10% gains in a certain amount of time and you only achieve 7 or 8%, maybe you don't want to sell because you say, oh, but I thought I would get 10% out of this deal, but the prices go down and down and down, and in the end you end up having a loss in your depot. And so it is basically important just to see what you can lose. So every time, the most dangerous phase in a trade is when you enter a trade. So once you buy a certain asset, this is the phase where you can accumulate losses, basically. So you buy something and then you place a stop loss to manage your losses at a certain price level. And once this price level gets met, the stop loss will trigger, you will sell your assets and you're out. But ideally, you enter a trade, you place your stop loss, prices go according to your expectation, and you can just track, you can just retrace your stop loss and pull it up or down according to the prices. So let me just make an example. Just for example, this movement. You're thinking, oh, this correction will go down, and it goes down, and maybe you enter here into a trade or there, somewhere in there, and you say to yourself, okay, well, if the prices go below this threshold, I will sell my Bitcoin, as I'm in Bitcoin right now, and you place your stop loss down here. Then you just wait for the prices to develop and to go up or down, and basically maybe the prices go up like this, and they go here, and you say, oh well, or they go down here, and you place your stop loss here, and when you bought here and your stop loss there gets triggered, even if it goes down only a short amount of time, you still end up having no loss, but rather a small gain. So in trading, it is always more important to be consistent than to focus on great big gains. Eventually, you will have gains, where you will have times where you participate in such a movement and make a lot of percent gains. But this doesn't happen that much. So there's always a certain amount of risk when entering a trade, and you want to manage that risk. And basically what you do is you use a stop loss. So for example, if I just said, okay, well, I expected Bitcoin to go down here somewhere, I would say, well, this is the bottom of the previous. So for me personally, because I use the Elliott wave analysis method, I would say, okay, well, the bottom of the previous wave 4 is a very good entry point. So I would basically enter somewhere around here in Bitcoin, or place my buy order somewhere here, or probably I would have bought here already, who knows, and yeah, I would place my stop loss somewhere down here. So especially if I have such a significant low, I would place my stop loss right below this low. So basically my expectation would be that when prices go down, my stop loss here would get triggered and I would sell my assets and yeah, maybe have a small loss, but it's better to have a small loss than to sit in assets with minus 50% or something and risking more from your depot. So that's what it's all about. And once the prices go up, you could place a stop loss somewhere, I don't know, somewhere at a low. Maybe this is a significant low to place a stop loss. And when prices go down, stop loss gets triggered, and yeah, you still have at least this gain, which is pretty much safe. And it's always important, basically as soon as you have the chance to take your stop loss into profit, you should basically do this, and just so you don't lose any money. And yeah, if prices go down below a certain threshold, like here, and prices go up again, you can always reinvest your money. It doesn't matter if you didn't get the perfect entry point or the perfect exit point, because you rarely get the perfect entry or exit points. Usually you are somewhat off of the perfect target, because it's just in 99% of the cases not possible to find the best entry point in a price movement, because you're just because no one is a clairvoyant and no one can see the future, and it's just always a best guess. And so this is how you should handle trading. So yeah, basically just try to get the best possible entry point, raise your stop loss into profits as soon as possible so you don't lose any money. This is the most important thing, also in connection with money management, and those two factors are very, very important. And as soon as you don't make any losses, even if you're minus plus 0% out, it's still better than yeah, than having 1% loss. So it's always good to just take your stop loss to an area where you are in profits, and then secure your position that way. The third point is using the correct leverage. So obviously you can buy leverage products on the market, like certificates or options or whatever, but you should ideally, or CFD contracts or whatever, and you should ideally just yeah, read a lot about those products to be sure what you buy. I personally like to trade with certificates from different financial institutions, because to me they are very transparent in the terms of the price calculation. I can easily estimate yeah, how much money I will lose when it hits a certain price, and yeah, for me they are very transparent, and yeah, I like to trade them very much. Other people don't like to trade them at all. They like to trade CFDs, so it's always up to the individual person. But yeah, the important thing is, in my opinion, or in my experience, I tend to not use that high of a leverage. So I try to buy certificates or leverage products up until a leverage of 10, which is already pretty high, which always leaves a fair amount of space for me to place my stop loss orders, just to be safe. And because, as I said, there's never any security, and you never know for sure the prices go in a certain direction or hit a certain level. And so it's always important to keep this risk in mind, and and don't get emotionally involved, thinking, oh, everyone's buying, I need to get in as soon as possible with high leverage, I can only win. That's usually the point where you lose money. And yeah, just be calm, wait for the right moments to enter, then buy with a moderate amount of leverage or no leverage at all. Especially Bitcoin is a value which you can trade very good without using any leverage, because even if there's no leverage involved, you will get price movements like this, where you have this huge move up 40% in 3 days, which is absolutely ridiculous in my opinion, and it's basically not possible in any other mass traded asset which is on the market. So this makes Bitcoin really special, and especially good, yeah, especially good to trade, because yeah, you have those movements, and yeah, you can obviously profit from those movements. And yeah, that's basically, these are the 3 most important points in trading. And if you follow these 3 points and don't get, yeah, don't get too risky, you can actually make a decent amount of money out of trading. But yeah, the important thing is manage your expectations, manage your money, and use correct leverage. So these 3 always go together, and yeah, basically make or break the perfect trading career. Okay, so I hope you enjoyed this video. If you have any questions, as usual, you can leave them in the comments. And yeah, I hope to see you soon again. And goodbye.